Ray Dalio is, of course, one of the most popular investors in the world, notably for being the founder of Bridgewater Associates, which to this day is still one of the biggest investment firms out there at over $120 billion of assets under management. And while Ray has already stepped down from the CEO role, he is still the senior investor at the firm and actively manages their investment committee, which really handles all of their biggest investment decisions. Well, speaking about those investment decisions, the company's most recent quarterly filings were just released to the public about a month ago, and we got to see the biggest stock purchases that they've been making. And so in today's video, we're going to take a look at the top 5 largest and most recent stock purchases that Ray Dalio and Bridgewater Associates recently made. And I'm going to give my opinion on each one of those stocks, and I'll even rank them from best to worst based on my opinion as well. And as always, of course, I'll let you know if I'd consider buying any of these stocks too. So it's going to be a ton of fun. I love doing these videos for you guys. I know that you're all a fan of them too. So go ahead, sit back and relax, and let's not waste any time. Let's just go ahead and jump straight into this list of the 5 largest and most recent purchases from the second quarter. All right, so counting down here from smallest to largest position in the portfolio, purchase number 5 was actually an ETF in the iShares China ETF, ticker symbol MCHI, which is managed by the giant BlackRock. And Bridgewater decided to more than double their position on it here last quarter at over a 120% increase, bringing the total stake in the ETF up to over $63 million. Now, to be honest, this doesn't really surprise me too much, as Ray has stated several times in the past that he thinks Chinese stocks will perform better over the long term than really most other investors would admit or realize, and it's a sentiment that I somewhat agree with myself too. Yes, the near-term picture is still looking very bleak right now for Chinese stocks, given the regulatory crackdowns, geopolitical tensions with the US, and an overall macroeconomy that already had enough issues to deal with before the pandemic made things even worse. However, I agree with Ray here that over the longer term, China will most likely recover. And trust me guys, I understand all the criticisms of China, which I agree with practically all of them myself too, but this is way too big of a global powerhouse with the second largest economy in the world, and nobody else even comes close, by the way, to think that we're just gonna all of a sudden stop doing business with China and maybe even go to war with them. Because first of all, if we go to war with China, you're going to have way bigger problems on your hand than, just seeing whatever small positions you have in some Chinese stocks falling, which most of us investors are wise enough to keep our exposure to China to a small amount anyway because of the risk. And given how much the Chinese market has already crashed recently, I just think that right now looks like a, pretty reasonable time to start chipping away at a position or two. For example, 2 of my favorite Chinese stocks are Baidu, which is currently down over 60%, and Alibaba, which is down over 70% from the top. And while these are, of course, high-risk investments, an ETF may actually be a good way of diversifying into more stocks to help lower some of that individual risk. MCHI, for example, holds over 600 Chinese companies, with Tencent, Alibaba, and Baidu all included in the top 10, which I happen to own each one of those, and they're my 3 favorite out of any Chinese stocks. Still, I do generally avoid ETFs given how much more I just enjoy handpicking each of my stocks individually, but the fact that this ETF is currently down over half its value does at least make it a somewhat attractive alternative with a good PE ratio and a decent little dividend above 2% to go along with it. Just keep in mind though that this is one that is more heavily weighted towards Chinese tech, so if you're not interested in that, then you might want to look somewhere else. But ultimately, I think Bridgewater will probably have some long-term success with this one, and because of that, I'll be nice here. I'm going to go ahead and rank it at number 4 instead of the very bottom until I see what else is on this list. Well, moving on to the next stock here, stock number 4, unfortunately, and I would say quite surprisingly too, we're actually going to get stuck here with another Chinese ETF. in the iShares China Large Cap ETF, ticker symbol FXI, which they nearly tripled their position on last quarter, increasing it by almost 200%, bringing the total stake up to over $88 million. Now, where FXI differs from MCHI is that it focuses on larger and much fewer individual stocks. In fact, while the previous ETF held over 600 stocks, this one only holds around 50. So it's much more focused in that sense, and the average weighted market cap is also about $10 billion larger as well. It also has heavier exposure to finance, but it is still very dependent on the technology sector too, so that kind of balances out a little bit there if you still wanted a lot of tech there. And Alibaba, Tencent, and Baidu all make the top 10 list here as well, which is something that I would want to see. At the end of the day though, both of these two ETFs are just going to share many similarities, so you can kind of pick whichever one you'd prefer, but both are China focused, both are down about half their value from the top. Both pay a dividend of around 2.5%, which is helpful, by the way, because both of them actually have pretty high expense ratios of around 0.5%. So the dividend helps to cover that. But the main differentiators, I would say, again, you're just going to have here FXI holding much fewer and larger overall stocks. It does, however, have a cheaper PE ratio of around 11 versus almost 14. So while I personally wouldn't invest in either one of these two, I'll have to give FXI the slight edge here because of that better valuation. It also feels a little safer, I guess, considering that these are only the largest Chinese stocks rather than smaller, and perhaps riskier ones. So I'll give FXI the edge here. I'm going to put them at number 3, right above the other Chinese ETF. Okay, next up on the list though, we are going to have here actually a stock that I've been a very big fan of in recent years. And it's also one that I'm actually invested in myself too. And that is the pharmaceutical giant Merck, ticker symbol MRK, which they increased their position on last quarter by about 50%. Growing it up to over $157 million, which is also worth just shy of 1% of the entire portfolio. Now, there's a lot to like about Merck here. They're one of the largest in pharmaceuticals with the 4th largest market share in the entire world, just barely behind Johnson & Johnson, while Pfizer and AbbVie take up the number 1 and number 2 spots respectively. But that giant size and the dominance of Merck with not only the best-selling drug in the world in Keytruda, but also 7 blockbuster drugs that do over $1 billion each, well, it's allowed Merck to maintain giant financials over the years, which they not only use to reinvest right back into the business, spending about a quarter of their sales on research and development every year at over $13 billion just last year alone. I mean, that's huge. But they've also been able to grow a dividend for over a decade straight, which currently yields about 2.7%. It's pretty attractive. And while the stock has already risen to a new record high, the valuation is actually still pretty affordable at a forward PE ratio of less than 13 and a PEG ratio of only less than 1. That's very attractive for a world leader like this, and it's why I continue to invest in the company myself. However, with all of that said, I actually think that there's a couple better options just specifically at today's prices. And I would say that is the case notably with Bristol Myers Squibb and Pfizer, who both yield a much higher dividend of almost 4% and 5% respectively, yet both stocks are still significantly cheaper too at PEs of only around 8 and 10 as well. All of them are going to be, really solid long-term choices in my opinion, but with Merck currently trading near a record high, I'm just a little more hesitant to buy any more shares at this time. But, I'm still going to rank it higher than both of those Chinese ETFs that I don't have much interest in anyway. So I'll put Merck at the number 2 spot for now. Okay, that will, however, leave us now with the final 2 stocks of the list. And coming in at the second largest position here, that's going to be yet another bet on China with the Chinese e-commerce giant PDD Holdings, ticker symbol PDD. I usually just refer to them as PD, by the way, because I don't like to say so many letters and words. But anyway, after selling that stock in each of the 2 previous quarters, Bridgewater decided to grow their position by over 27% this past one, bringing the total stake in the company up to over $188 million, which is also the first stock on the list to be worth more than 1% of the overall portfolio. Now, if you don't know anything about PDD holdings, I'll just keep this very short and to the point because I actually made an entire review video on them recently, which you can check out if you want a more in-depth analysis on them. But they're basically the company behind Pinduoduo, which is already the third largest online shopping platform in China. And that's a huge deal because China is the number one largest e-commerce market in the entire world. However, the company is also looking internationally for even more growth potential as they recently moved their headquarters over to Ireland in an effort to lower some of the regulatory and geopolitical risk that they face as a Chinese company, while also launching a fast-growing international kind of budget-oriented shopping app called Temu that is not only rivaling other giants like Alibaba's AliExpress, but it was even ranked as the number one most downloaded app in America earlier this year, and that's pretty impressive. So, with the combination of already solid financials plus the international expansion and the growth potential, PD has really become a very popular stock these days, and it's one that I've even thought about buying a small amount of myself too. However, I have been hesitant to really pick it up for mostly two specific reasons. Those being that number one, I already own 4 different Chinese stocks as it is. And number two, the stock also climbed recently by over 25% in just the past 3 months to almost a 52-week high. So I think I would need a bigger dip to convince me to add this one as a 5th Chinese stock to my portfolio, which I just think is too many. However, it is still down over half its value from the top, and with a really cheap PEG ratio of only less than 1, I think it makes for a pretty good speculative stock overall. So while I'm staying on the sidelines for now, it's a stock here that I will definitely be keeping a very close eye on. And for the purposes of ranking it, I'm going to go ahead and move the 2 Chinese ETFs down a spot to number 4 and number 5 so that I can fit PD right under Merck at number 3. Alright guys, that's going to leave us now with the final stock of the list. And coming in here at stock number 1, the largest of these 5 holdings, well, it's actually going to be another ETF, the third one that we've seen so far. Thankfully though, unlike the previous 2, this one is actually not a China-focused ETF. Instead, it's a core-based S&P 500 ETF, which is also made by BlackRock's iShares. And Bridgewater decided to increase their position on it last quarter by just about 10%, bringing the stake up to nearly $900 million, with this also being the first one on the list to make up over 5% of the entire portfolio. Now, there isn't really a whole lot to say here because, like I said, IVV just tracks the broader S&P 500, making for a relatively safe but also a bit boring of an ETF. You know, this isn't going to be one that gives you like specific exposure to other countries or sectors or technologies. It's not going to be focused on artificial intelligence or healthcare or the metaverse or finance or on paying out huge dividends. It's just a broad market tracker with some of the biggest, safest American companies. So if you think the US markets will go up over time, then you can just buy an ETF like this and lower your risk from having to pick out individual stocks yourself. And that is a bet that I very much believe in. I mean, I still foresee America being the best place to invest in, with amazing giants like Microsoft, Google, and Amazon all making the top 10 largest holdings in this ETF as well. And it even pays out a little dividend here of about 1.6% with a very small expense ratio of just 0.03% to own it. However, just keep in mind that the US market is up a lot right now, with the ETF's PE ratio sitting above 23, so you might want to wait for a bigger dip, especially if you think a recession is coming soon. But regardless, most people probably buy this ETF little by little over time without really having to think too much about all of that different stuff. And because of its lower risk than the 2 Chinese ones, I'm going to have to rank it higher at number 3, which will give us our final rankings of Merck at number 1, which again, I think Pfizer and Bristol Myers are more attractive at today's prices, but Merck is still a solid bet in its own right. Then we put PDD Holdings at number 2, obviously higher risk being a Chinese stock, but considering everything else is really ETFs, which I think are kind of boring and I just have no interest in, well, PD kind of gets that number 2 spot by default. And then I put IV at number 3, just ahead of the 2 Chinese ETFs because of the overall lower risk of being an American-focused ETF rather than a Chinese one. But there you have it, guys, a very ETF-heavy quarter here, and especially a very heavy Chinese-focused quarter with 3 out of the 5 stocks here being all China-focused, China-related. And that is pretty surprising to me. I wasn't expecting to see that many be on the list. Overall, I'd say pretty mediocre quarter in my opinion. Not really stocks here that I'm very excited about myself. I would pick alternatives for every single one of these, so not the biggest fan. However, Merck is, in my opinion, the clear best one of them, and I think it's a pretty solid stock long term, and of course I own it myself too. But what do you all think? Do you own any of these stocks, and do you agree with my rankings? Would you make any changes? I'd love to hear your feedback down below in the comment section. Thank you again for all the support, my friends. Thank you for stopping by, for liking the video, subscribing, and especially all the people that go above and beyond and support me on Patreon. It means so much to me. Thank you. But I will catch you in the next video, my friends. Hope you're all doing well. Take care. Bye-bye.